This is Bloomberg Markets Today. I'm Anna Edwards, live in London with Tom Mackenzie.
The cash trade is just less than an hour away. Here are your top headlines. The US speeds up military assistance to Israel. Turkish President Erdogan criticises Biden for sending warships to the region. Elsewhere, Treasury yields dropped by some of the biggest margins this year on hopes the Fed could be done raising interest rates. Shares in Asia rally for a fifth day. Plus, LVMH sees sales growth softening in the third quarter. More evidence the post-pandemic luxury boom is waning.
OK, lots to talk about this morning then, from the geopolitics, of course, from violence in the Middle East ongoing. Of course, we'll get an update on that front. But in terms of the market story, fast focusing increasingly on what the Fed is doing and what the Fed might not do when it comes to November, Tom. That's guiding market sentiment, along with expectations now, it seems, of further stimulus in China. Yeah,
those two factors seem to be coming to play when it comes to these markets. In terms of the reported stimulus coming through from China, it hasn't been confirmed yet, but again, it could be consequential, around 140 billion US dollars, potentially is what's being reported by a team on the ground, of course, in China. And then this growing consensus, it seems, if not consensus, then the increasing number of voices coming through from Fed officials suggesting that maybe they are getting closer to pause territory, given the run-up in yields that we've seen. And certainly the markets are now starting to price in far fewer hikes, if any, by the end of this year, additional hikes from the Federal Reserve. The expectations around the next meeting have fallen off significantly in terms of the expectations of whether or not a further hike will come through. Futures in Europe, though, after a very solid day yesterday, pointing lower by about 0.6% so far as we lead up to the Wednesday open. FTSE 100 futures pointing lower by about 20 points. DAX futures off by about 45 points, looking at 15,490. For further estimates and a bit more colour in terms of where the Fed may go, of course, we do have the Fed minutes out later today. Let's switch it over and see how the futures are shaping up for the US. Again, a pretty decent session in the United States and the context as well when you look at Asia, again, in the headlines, fifth straight day of gains for Asian equities. But back to the US then, and futures for the S&P are flat right now. Nasdaq futures looking to add about 15 points. Dow Jones futures looking flat as well, just off by about 0.1% to flat. We're looking again for those Fed minutes later today. And then the CPI print, how consequential will that be? Or is the focus less on inflation now and more on what happens in terms of the trajectory of that yield curve? But again, the CPI and the inflation print out tomorrow. Fed minutes out later today, Anna.
Yeah, and PPI today as well on the inflation side of things. Tom, let's have a look at the GMM then. So you've been through the futures story. Things looking fairly mixed and flat in the US, but that's far from what we saw yesterday. Great deal of strength coming through yesterday, in particular in European markets, but also over in the United States. Gains of more than 2% on some of Europe's markets, so perhaps no surprise we expect a little pullback today. We're seeing some of that positivity through the Asia session, lifted by those dual forces, the changing conversation around the Fed and the shifting expectations, the heightened expectations around Chinese stimulus. That's what we see boosting equity markets through the Asia session. It's kind of a mixed picture when it comes to FX. We have the Aussie dollar just on the back foot a little, the South Korean won up 0.7%, and more broadly the dollar is pretty flat. The dollar index, the Bloomberg dollar index and the other, both flat this morning. In terms of sovereign bonds, we're still watching adjustments in yields around the Fed story and around the violence in the Middle East. So that is causing money to go into the perceived safety of bonds, or it has been doing, and now we're seeing some adjustments around that story. So we see US two-year yields going higher as we see selling at the shorter end of the curve, but actually things look fairly mixed. The 30-year looks, in contrast, to be showing a lower yield story. So a little bit of divergence across the Treasury curve as to what we are seeing there. On commodities, a more mixed picture than we've seen of late, perhaps. Brent, just up 0.1% at 87.78. Let us talk to Eddie van der Welt, who joins us from the Markets Live team and can talk to us about the markets in 3 minutes. Eddie, very nice to have you with us. Let's concentrate first on the dovish messaging from the Fed. It seems to be coming through again. We haven't necessarily heard from the hawks on this front, which will be more consequential perhaps for the markets. But we've done, I know the Markets Live team have done their own analysis on what it is that rising rates do to financial conditions, which is at the heart of the Fed's narrative at the moment.
Yeah, absolutely. Look, I think you're right. And, I do expect a little bit of a hawkish pushback. But the doves, and what is interesting is that we are seeing a slightly dovish tilt from everybody, right? Mary Daly, latest to come out and saying that, perhaps Jefferson and Logan was right by saying that higher, longer-end yields tighten financial conditions such that the Fed might not have to hike as much, in the short term. Neil Kashkari has disagreed and so on, and MLive has looked at these numbers, and we've seen that, you're not necessarily, when you see bear steepening, you're not necessarily seeing inflation coming down very much, even with a year's lag, right? So there is some question marks. This is somewhat unorthodox. What's perhaps more interesting, though, is that Daly said that the neutral rate may now be higher. So she's expecting to stay at these levels, right? She's not expecting there to be a lot more hikes, but she's expecting to see rates stay significantly higher for longer. So I think what they're talking about is a Fed that is done hiking for now and no immediate need to cut. That probably means for the yield curve, a little bit of bull and bear steepening together initially, and then from there on out, just more bear steepening.
Yeah, she was talking about a neutral rate of between 2.5%, maybe 3% longer term then from the Fed. And you flagged this, you touched on what Kashkari had to say, and a bit of pushback coming through because he suggested, look, maybe this is about the markets pricing in expectations around where we go next, and maybe we have to fulfil those expectations to continue to maintain yields at this level to do the work that we are hoping it will do in terms of squeezing prices across the board and keeping that inflation on the right trajectory. What do you read into that tension?
Yeah, absolutely. Look, I think if they suddenly don't deliver on that, then you don't need to see longer end yields quite as high as they are right now, and then you're going to see the back end of the curve coming off as well, and the tightening that they're talking about that's coming through via the long end then disappears. So it's a balancing act. If they want to see this, fulfilled, they need to keep the narrative at least such that the rates will stay high, and therefore, they can't do too much at the short end.
OK, Eddie, briefly, the worst over for chips on Samsung?
I hope so, because it's a bellwether, right? If chips look better, then that's definitely good for the rest of the world economy. Samsung, not as bad as people had expected.
OK, we'll certainly keep an eye on that, and the inflation data coming out of the US later today and tomorrow. Thanks to Eddie for the update. Remember, you can get up-to-date analysis and insight from Eddie and the rest of the Markets Live team. MLIV Go, that is the function to use on the Bloomberg terminal. Coming up on this programme, we're live at the IMF annual meetings in Marrakesh with the Moroccan finance minister joining us. That's at 7:20 a.m. London time. Stay with us for that conversation. Plus, in the post-pandemic luxury boom, is it starting to cool? We will discuss after LVMH reported sales growth that softened in the third quarter. If you have any questions for our guests, we'll get a guest on the luxury space later in the programme. IB plus TV Go is the function to use on the Bloomberg terminal. We'll bring you the latest from the Markets Today blog as well. If you want to check out that blog, go to the Bloomberg UK website, click through to the blog page from there, or you can type TLIV Go on the Bloomberg terminal. This is Bloomberg.
We feel like we're on track for a soft landing. Inflation has come down quite a bit. The labor market has remained strong. Maybe we can get inflation all the way back down and avoiding a deep recession. That's what I would call a soft landing. So far, it's looking more favorable.
I think that our policy rate is at a sufficiently restrictive position to get inflation down to 2%. I actually don't think we need to increase rates anymore.
If the markets, in the case recently, bond yields have tightened, meaning financial conditions have tightened, that's an indicator financial conditions broadly have tightened, it's more expensive to get a loan, then, well, if that's tight, maybe the Fed doesn't need to do as much. That's why I said, depending on whether it unravels or whether the momentum in the economy changes, that could be equivalent to another rate hike.
OK, that was the Fed's Mary Daly, Raphael Bostic and Neil Kashkari speaking about the rate path ahead. Joining us now is Tatjana Greil-Castro, co-head of public markets at Muzinich & Co. Tatjana, thanks so much for coming to the studio this morning. Is this a Fed that is now on hold? Is it done? Are you convinced that this is a Fed that is now down, listening to those comments?
Well, to me, it is a Fed where finally the market is listening again to what the Fed is actually saying. And I think what we've seen is that for the longest time, the Fed was saying, there is more to come. We know there's a soft landing. And what did the market say? The market said, but look at the yield curve. The yield curve is inverted. Therefore, the Fed is wrong. The yield curve is always right. We are in a recession, or we are going into recession because the yield curve is inverted. Now, I remember I've said for probably the last 12 months, I said, well, if everybody is looking at an indicator and to use this indicator as a forecasting tool, that indicator is losing its forecasting ability. And the yield curve was that tool. Everybody used it as a forecasting tool. That's why it inverted, and that's why it lost its predictive power.
Should we have been looking for it to predict, Tatjana, given the role of the Fed in bond markets, given the role of central banks globally, has the power of that?
No, I think we shouldn't have.
We shouldn't have.
Yeah. That is the outcome of... is the outcome of fundamentals. Then the yield curve is inverting because the recession is coming, but it's not. It doesn't have a predictive power in itself. So the causality was the wrong way around, right? We were saying, oh, this has strong predictive power, and therefore everybody followed the narrative, and then therefore the yield curve, because the trading happened that way, the market was positioned that way. So the recession had already been predicted without the fundamentals suggesting that there is a recession, and this is unraveling now. So slowly, we are realizing, well, actually, the economic data is much stronger than this. And where would it go? I mean, it was already extremely inverted, more so than ever. So where would it further rally? So then if it doesn't rally, why would you own duration? And so this is what we are seeing now. And then and then the other thing that we've been discussing since the summer, really, since about May, and we said, OK, if we know that an inverted yield curve is an anomaly, and we don't believe that this is how it always should be, and it should be downward sloping, then we know when we go from inverted to downward sloping, right, it's like a seesaw, it will be flat at some point. And then we ask ourselves the question, if we know it has to be flat at some point, at what point does it flatten? Does it flatten at the 10-year, which at the time was at 3.5%, expected to go to 3%? Or will it flatten at the 2-year? Or will it even flatten at the 3 months? Right?
Where do you land on this now?
Well,
Tatjana?
We can see it is flattening. It is flattening at the 2-year.
In terms of where you want to position. So it's flattening at the 2 end.
Yes. Yes.
And is that a theme that you expect to continue? And what does it tell you about where you would advise clients to position along the curve?
Yeah. So at the moment, we're advising clients that while we are transitioning from this extremely inverted yield curve to a normalized yield curve, clearly you don't want to own duration. You want to be very short-dated. It will flatten either around the 3 months, then it has even more to go. It would have even another 0.5% to go, or the 2-year, then it has about 20 basis points to go. And from the latest comments, it could even go at the 3 months, so there could be some pain still ahead of us. There will be events that are unpredictable, and then, it rallies a little bit. But as a large trend, when you look at what's going on in the shift that we have from the current economic system to what I sense more and more, a new economic system, that shift actually will require a lot of investments, but also a lot of destruction.
Tatjana, what's the role of fiscal policy at the moment? A lot of our conversations that talk about where the US economy goes or European economies go end up talking about where we are on that fiscal impulse.
Yeah.
And I ask this also in relation to debt markets, because I saw yesterday Fitch put out some research. They downgraded the US, of course, in August, the sovereign debt. And now, if you look at the whole pot of sovereign debt, the percentage of that sovereign debt that is junk is now bigger than that which is AAA. And this is a sort of rare occurrence, I suppose. And I think maybe tells us something very interesting about the amount of debt that is out there and the fears for the future as to whether it can be paid back. How does the fiscal impulse and that play up against each other?
Yeah, I mean, that is a very important dynamic where, I think we still live with the sense of austerity from the global financial crisis, right? The reaction was austerity. But clearly, since COVID, we have gone completely the other way. And that is still going through the fiscal system. Remember, the ECB used to say, well, we are negative rates. We do everything we can to stimulate the economy. But you, on the fiscal side, you do nothing, right? It's now the other way around. down. Central banks are trying to slow things down, but the fiscal stimulus continues. And so there is that, so that we have QT, we have fiscal stimulus, we have higher cost of debt, so there is more borrowing just to pay the higher debt burden. And at the other side, so foreigners, especially when it comes to US debt, when you see the largest foreigners, which is China and Japan, their dynamic of buying treasuries, there's a reduced demand. And so you have more supply, less demand, QT, and all those things can't be underestimated either.
Tatjana, I mean, you can make the argument that these are Fed officials, from what we've been hearing, who are getting anxious. They're anxious about the effects of high rates. They're anxious about the run-up in yields. They're anxious about quantitative tightening and all the political risks domestically in the US and the geopolitics as well. Something's going to break. That's the fear. Something's going to break. What is most at risk of breaking in this environment?
I mean, at the moment, and I think this is what also the Fed speakers are saying, right? The reason why they're more and more confident that there is no more rate rise by them is because the whole curve is going up. So they don't need to do more to pull everything up. And so, yes, of course, at some point, you know, bringing it back just to wanting to own duration, at some point you will want to own duration.
Is credit the big risk now versus concern about price inflation? Is the focus shifted to the concerns and risks around credit?
So we would definitely say don't, because a lot of people missed out on owning credit this year, and they now feel, oh my God, I miss it, you know, this fear of missing out, right? So we need to own more credit because clearly it's doing really well.
Okay.
We see the best returns and the easiest returns are behind us. Don't reach down to single Bs and triple Cs because those will be the ones that struggle to refinance at higher rates.
Tatjana, thank you so much for your time. Tatjana Greil-Castro, co-head of public markets at Muzinich & Co. Now, the IMF says Africa's economic activity will likely slow again this year amid taxing headwinds, but is expected to recover in 2024. This week, central bankers, ministers of finance and business leaders are in Morocco at the IMF and World Bank annual meetings to discuss issues of global concern, including poverty eradication and economic development. Let's find out what is being discussed as we get some insights from, on the ground, Bloomberg's Francine Lacroix, who is at the IMF event in Morocco. Francine.
Anna, thank you so much. And we are delighted to be joined by the Moroccan finance minister, of course, Minister Alaoui, joining us to get us really started on this IMF World Bank meetings. Minister, thank you so much for joining us. And thank you also to playing host to this. The last couple of days have been extremely difficult for the international community because of the loss of life in Gaza and in Israel. How does this change geopolitically the world economy?
First, our condolences to all the victims, and we're calling for a most peaceful world, and His Majesty is calling for a meeting of the Quds Committee today. Of course, once again, this tragedy will probably hit the economy, especially oil prices and energy prices. As of Morocco, we are watching carefully this and preparing maybe to adjust our action plans, but we don't see for the moment any direct impact on our expectation for growth and macroeconomic fundamentals for 2023.
Do you worry that actually if this escalates, it again puts central banks in a very difficult position?
Of course, yes, it's definitely a risk, and hopefully we'll be hearing from them. They're all gathering in Marrakesh this week, and hopefully they will be wisely managing this situation.
Minister, what does it mean for there was also normalization, of course, of ties trade-wise between, thanks to the Abraham Accords, between Morocco and Israel. Will there be conditions actually that you will be putting for this to go forward?
Look, Morocco has in its DNA openness to all the world, and Abraham Lincoln's Accords is one of them, and we are definitely committed to be open to the world and to trade, to work with all the parties in a really very constructive way.
Is there a danger also, Minister, that actually investors, Morocco is going through a little bit of a boost, right, with the investor community being quite confident that you're on the right trajectory so far, but do you worry that again, the Middle East becomes a bit of a hotbed, investors will be very shy to come back in with force.
We are really optimistic about relationship with the investors. We raised some money this year with the sovereign bond, and I think that Morocco is a really reliable partner. The reform agenda is implemented with discipline and within a proper framework. And we think that investors knows this. He knows that the role of Morocco in the growth of Africa is very important, and we are keeping a strong relationship, explaining what we are doing, and giving all the assurance that we can, I would say, get this money and make it profitable for the investors.
So, Minister, what are you looking at specifically to actually, I guess, give yourself the best chance to go back to investment grade?
We've discussed with the rating agency, telling them that our fundamentals today are much better than the moment we had the investment grade. There was some precedent conditions like exiting the GAFI list and going, I would say, getting the flexibility line from the IMF. So we have an ongoing conversation saying that we definitely are ready to get back our investment grade.
Parts of Morocco were, of course, also devastated because of the earthquake. So you have very strong short to medium term financing needs. Again, what's the right mix of making sure that longer term there's still enough money in the coffers?
So this after this human tragedy of the earthquake, the idea is to build back better. So we have a comprehensive plan for 5 years. It's 6 provinces that are in this plan. So a large part of the funding for this plan is within the budget of the state, because we had, I would say, money available for this. Of course, you have to do some arbitrage in the department, saying this will go first to these provinces and the sequence will be probably changed. And in the course of the 5 years, we will, I would say, look for funding for the gap that is needed. But we have time and we have the money for the first action plan, and we are in discussion with all partner international cooperation to fill the gap.
Morocco also has free trade agreements with the US, the EU, and Turkey. What kind of relationship do you want with China? What do you think? Where do you think that will end up in a couple of years?
We have a relationship with China, but now we are discussing much more actually areas around the electric batteries, etc. So I think that there is a room for I would say a stronger partnership, but in a global way, because Morocco have definitely made the choice, as you mentioned, to be integrated in the value chain. And we have a lot of capabilities, and we have, I would say, very good geographical location that I would say can be really an asset in these relationships.
Minister Alaoui, thank you so much for joining us today on Bloomberg. Good luck with the rest of the IMF World Bank meetings. Of course, we'll have plenty more from Marrakesh here in Morocco throughout the day, Tom.
OK, Bloomberg's Francine Lacroix, of course, on the ground in Marrakesh. Thank you, Francine. A line crossing now from the UK and the relatively newly appointed Defence Secretary Grant Shapps of the UK, saying that Israel should deal with Hamas once and for all. And, of course, Hamas is designated a terrorist organisation by the UK, the EU and the US, and the UK has been out front in giving unequivocal support to Israel, and reiterating that today by the Defence Secretary here in the UK. Coming up, President Biden vows more military support for Israel, while Turkey's Erdogan warns of a massacre in Gaza. Prospects for peace in the region continue to dim. We bring you the latest. This is Bloomberg. Welcome back to Markets Today. A little under 30 minutes from the cash equities open.
Let's get to your top stories this morning. The US speeds up military assistance to Israel. Turkish President Erdogan criticises Biden for sending warships to the region. Elsewhere, Treasury yields drop by some of the biggest margins this year on hopes the Fed could be done raising interest rates. Shares in Asia rally for a fifth day. Plus, LVMH sees sales growth softening in the third quarter. More evidence the post-pandemic luxury boom is waning. Tom, let's come to you then on the futures picture, because I mentioned what was happening there in Asia, driven really by that lower yield environment over in the United States. But that conversation keeps on moving. And, of course, European stocks gained a lot on that theme in yesterday's session. So where do we go on futures?
It seems like you're going to get a bit of a pause for breath when it comes to the run-up that we've seen in European equities, at least over the last 24 hours or so. Very solid session put in by European stocks yesterday, led by travel and leisure, which posted gains of around 4%. Basic resources also did very well as well on the back of the reports, the Bloomberg reports of additional stimulus coming through from China in the shape of about $137 billion worth of potential infrastructure spending. But today, futures are actually pointing lower. Taking a bit of a pause, again, we have the Fed minutes out later today, the inflation prints coming through from the US as well. Maybe investors waiting for a little bit more clarity after what has arguably been a little bit more dovish commentary from these Fed officials. DAX futures then pointing off by about 0.3%. Here in the UK, the FTSE 100 pointing down by 19 points, 0.2%. And over in France, the CAC are off by 0.8%. Of course, the luxury sector will be in focus given those disappointing earnings out of LVMH. Anna.
Yeah, absolutely. That could be a sector to watch at the start of trade for sure. Let us find out what has caught Kriti Gupta's eye this morning. Kriti, we talked quite a bit about the Treasury markets with our guests earlier on this programme. What catches your attention then when it comes to the curve?
Well, a lot of cross currents here, Anna. We're talking about the bond volatility of the last couple of weeks. We're seeing the momentum, the selling off the long end of the curve matched with the flight to safety from international investors into U.S. Treasuries off the geopolitical conflict. Then on top of that, add on some pretty dovish Fed speak, and all in all, you get a little bit of a messy yield curve. At least that seems to be the investor take. Now, let me walk you through this. Essentially, right now at the bottom, we're seeing that 2s10s bond curve, the traditional kind of recessionary measure. Historically, every inversion of the 2s10s curve has predated a recession. Of course, that curve has been inverted for a very, very long time now. That being said, that curve is now flattening, and there's a couple pieces for this. Simply the idea is when you do see that curve flattening, the immediate thought is, does that mean growth in the United States is slowing down? Is that what the expectation is, that growth 10 years down the road is not going to be as positive as we thought? Well, yes and no. Yes, there is that idea that, okay, perhaps that recessionary call is coming back in through the function of the fact that the bond market is now pricing in cuts early and earlier. The geopolitical volatility is really helping that sentiment. The other piece of the equation is that, look, you are also seeing the Fed's balance sheet run off as well. The concept of market plumbing, of digestibility, is also in talks right now. Remember, you did have that 3-year auction in Treasury bonds yesterday that just completely did not deliver. We have a couple of other auctions throughout the rest of the week as well. So, Anna, it's not just about the bond momentum or what you think that the U.S. economy is going to look like in the next 10 years. It's about how people are positioning ahead of a lot of different cross currents. And right now, that's throwing, for lack of a better term, the yield curve into a little bit of whack.
OK, so we'll keep an eye on the yield curve, very much being influenced then, Kriti, by the Fed conversation, as you say, also geopolitics in the mix, and plenty of eyes on what's going on in the Middle East. So let's get an update there. Israel's airstrikes on the Gaza Strip have killed over 900 people, while the death toll from Hamas's attack in southern Israel has climbed to over 1,200. That is according to official sources. Both sides have reported mostly civilian casualties. President Biden says the U.S. is speeding military assistance to Israel following the militant group's surprise attack over the weekend.
When Congress returns, we're going to ask them to take urgent action to fund the national security requirements of our critical partners. The United States has also enhanced our military force posture in the region to strengthen our deterrence, and we stand ready to move in additional assets as needed.
Let's bring in Yusuf Gamal El-Din, our Daybreak Middle East and Africa anchor, who normally, of course, in Dubai, covering the region, is here in London this week. Yusuf, bring us up to date then on the international politics, how that is shaping around this conflict.
Yeah, I mean, the rhetoric was very strong from the United States, and basically, yes, sure, they have all the support they need. But unlike the Ukraine assistance, where you had a clear breakdown in terms of X number of guns, Y number of tanks, we didn't get it this time around. So just the promise of the world's largest aircraft carrier and ammunition. But We suspect it goes far deeper than that, and we'll await details. I'd also look out on the diplomatic front. The U.S. Secretary of State, Anthony Blinken, is going to be flying to Tel Aviv. He's going to be going to Jordan, to Amman as well. And they're going to try and see if they can find a way to get all the stakeholders around the table and bring an end to the violence. I also point to some commentary from the Turkish president. I mean, talk about irony within the own ranks. So within the ranks of NATO, you've got Recep Tayyip Erdogan now saying that any allocation of U.S. assets to this part of the world, well, the Middle East specifically, or around the area of Israel, is only going to create an environment for a potential massacre. The Saudis have been working aggressively as well in terms of trying to find a diplomatic off-ramp. They're saying they're going to try and make an intervention as well, at least diplomatically. Guys?
OK, Yusuf Gamaluddin with the latest in terms of the geopolitical shifting sands around this conflict. We appreciate the update. Thank you. Let's check in now on what you need to know heading into the Open. Sam Umstead joining us from the Markets Today blog. And we had the speech from the opposition Labour Party leader here in the UK, Keir Starmer, yesterday. Sam, what stood out to you? How well received was this after he shook off the glitter?
Apart from the glitter,
that was showered on his head in the opening seconds of that speech.
Well, I think the glitter was actually taken quite well over the course of it, because he managed to literally shake it off.
The Labour Party were pitching T-shirts.
Yeah, I'm sure. Yeah,
it
allowed him to roll his sleeves up and do all the things that I think politicians like to do in those situations. I think the speech itself was pretty well received because it was very policy heavy. You know, there was a lot of actually fairly clear ideas about what they would do. It's very much the kind of speech you would hear from an opposition that feels very confident that they are going to be in government over the course of the next year, or certainly going to be competing very hard to be. Particularly around housing, and sort of very clear ideas about this is how we're going to do this. You know, some of those will face some questions, particularly the NHS. You know, from a political standpoint, some of what he said may well face a little bit of opposition, but generally pretty well received from the business community.
Yeah, we just showed some pictures of the protester who applied the glitter and then was quickly dragged away. UK wage growth also being covered on the blog then, Sam. This has been a focus for the Bank of England. So what's the latest reading we're getting?
Yeah, so this is the survey from KPMG and the REC, and this is quite an important report because the BOE has cited this report in the past, and wage growth, according to this, is slowing. And actually, it's worth noting as well this morning, we had results out this morning from Page Group, one of the big recruitment companies, also saying the same thing, that the amount that's being given to candidates as salary increases has also slowed. So overall, fairly good signs in terms of the path for interest rates.
Sam, how much weight should we put on this comment and the analysis, the take from the IMF that the UK, the BOE, will need to hike to 5.5%?
Great question. I think actually, if you look at the data this morning, it sort of undercuts that to a certain extent. You know, the wage growth extremely important, right? So in the BOE's thinking, and it does appear to be slowing. There appear to be lots of signs of softening in the labour market. So yes, you know, there's always the possibility, and you know, as we've seen over the course of this week, there's always the possibility of these external geopolitical shocks coming into the market and changing the picture. But I think overall at the moment for the UK, it appears that everything is moving along as traders are currently pricing in for the rates to remain on hold.
It's very interesting the way that the UK establishment, I suppose, gets quite focused on IMF forecasts. There are plenty of other economists making forecasts every day about where the UK economy goes, but it is those forecasts from the IMF, those guys in dark suits who once stalked Whitehall. Let me ask you about so you mentioned what we'd heard around the labour market, which I think is really interesting in the context of what we heard yesterday from Robert Walters. So we're getting interesting insights, aren't we, from these recruitment companies as to which jobs are in focus. I mean, Robert Walters saying that legal jobs were in demand as finance and tech were struggling. So it's quite a nuanced picture.
It is quite a nuanced
where the demand is.
Yeah, that's right. And actually, their report was interesting that because of that, because it's mostly technology and finance that are struggling a little bit, legal jobs doing a little bit better. The regions were doing better. So London in particular is seeing a significantly more weakness than the rest of the regions of the UK. Page Group doesn't have quite so much detail in their report today, but the overall picture does remain pretty poor on the jobs front. OK,
Sam, thanks very much. Thanks for the update. Sam Umstead from the Markets Today blog. You can get more from the team that put together the blog. Go to the front page of the Bloomberg UK website. You can click through to the blog from there, or you can type TLIV Go onto the Bloomberg terminal. Coming up, we will put luxury stocks in focus. Luxury consumers, perhaps they're sobering up. LVMH third quarter sales missed estimates in most divisions across the brand. We will discuss that with an analyst next. This is Bloomberg.
Welcome back to Markets Today. A little over 15 minutes from the cash equities open. European futures currently pointing lower by 0.6%. And certainly the luxury story will factor into the equity moves at the open today. And LVMH's sales is front and centre in that. Growth softening then in the third quarter. This as shoppers reined in spending on high-end cognac and costly handbags. More evidence that the post-pandemic luxury boom is waning. Joining us now is Swetha Ramachandran, who is fund manager at Artemis, who specialises in leading consumer and luxury brands. Swetha, good morning. How concerning are these results then for LVMH?
Good morning, Tom. I think to set it in perspective, clearly there was a miss at their key fashion and leather goods division, which the market keenly watches, where it grew by 9% instead of the expected 10 to 11% range. I mean, it's not all doom and gloom, because they did see, for example, the Chinese consumer cluster continuing to grow about 40% on a two-year stack. I think where the big disappointment came from was the pace of deceleration among domestic European consumers, who have reined in spending far more quickly than had been anticipated, down between low single-digit to mid-single-digit rates in the quarter just ended. So there's some puts and takes here. And I think the question of deceleration was always a sort of given that this company grew by about revenues by 23% last year. These rates that they have seen of growth since the pandemic were seen as unsustainable. It was a question of when we would start to see those decelerate rather than if. And now that we're starting to see them decelerate, I think the question is really, where do we settle out in terms of growth rates, which can prove a sustainable base for growth going forward?
Swetha, what do we learn about the luxury consumer right now and where we'll see resilience and where we won't from these numbers? Because it did seem that there was some weakness in fashion, also some weakness in spirits. And I wonder what that tells us about the macro backdrop, the fact that the disappointments were not limited to one area.
Yeah, I think there's clearly a divide emerging between the more resilient higher income consumer and the more aspirational middle income consumer that's been carrying on for some time now. But it's particularly stark because categories like cognac in the US, for example, which has particularly been affected in terms of soft demand, but also an inventory destocking issue, are a function of their sales exposure to more middle income aspirational consumers. On the other hand, within their jewelry division, they called out Bulgari as doing better than Tiffany, which again highlights the sort of relative outperformance of brands that are catering to a more resilient upper income consumer.
OK, that's an interesting kind of brand breakdown, Swetha. What about the consequential regional shifts? What is standing out to you as the most significant change regionally in terms of the demand for LVMH and its goods?
Yeah, I think if we look at the European consumer, this was a relatively mature consumer prior to the pandemic, barely increasing in terms of revenue growth other than via tourism as a region for the group. What has happened over the course of the last 2 years is that domestic European consumer has seen a somewhat of a renaissance. Their spending on luxury goods versus pre-pandemic levels has gone up by over 50%. So that is clearly reducing from a very high increased base since post-pandemic as a result of the inflationary pressures that we're all too familiar with in Europe. And that has been a key source of negative surprise. What I was actually pleasantly surprised by was that the US consumer had stabilized. And this was the first consumer to start showing signs of a slowdown for the company about 6 to 9 months ago. And it appears to have stabilized now at a lower level, while the Europeans have been later to catch on. The Chinese cluster is continuing to grow at about 40% on a 2-year stack, which is the same as it was in the second quarter. Perhaps some disappointment on why it hasn't accelerated. And for that, perhaps we need to see a bigger return of outbound Chinese tourism, particularly to Europe, in order to see that manifest.
We've seen some confirmation of pricing around Birkenstock. So in other consumer brands, Swetha, this a listing that's being closely watched in the United States. We're seeing the controlling shareholder, L-Catterton, which actually links to the LVMH story, doesn't it? We're seeing them keeping a sizable stake in Birkenstock after the listing takes place. Does that give you confidence that they think good things for the future of the business, or does that create a stock overhang that you think will worry investors?
I think at the moment it's a question of sort of market sentiment and valuation around the stock, which is coming in at a pretty hefty mooted valuation of about over 5 times sales, which is kind of ahead of best-in-class consumer brands companies at the moment, given the recent sell-off in markets. So it could be a question of market timing and sentiment. and not wanting to basically flood the market with shares at a time when the appetite may be lower than it otherwise would be.
OK, interesting kind of your views there on what looks like a fairly stretched, at least according to your take, in terms of the valuation then of Birkenstock. Swetha, we have the team at Bloomberg Intelligence as well outlining potentially the upside for this company if they manage to kind of double down on under-penetrated markets and expand their distribution, their manufacturing capacity and maintain their margins. Are we in an environment where these kind of names can maintain margins, or whether it's Birkenstock or LVMH, are we looking at an environment where in slowing growth some of these margins are going to have to be given up?
Yeah, that's exactly the debate of the day, is that in a slowing environment, how much of your costs are really fixed and how much are variable that can be adjusted. We have seen the industry overall do a good job through the pandemic of making many more of their costs variable than used to be. That said, there's still a hefty fixed cost base that needs to absorb a lower volume of sales, which could lead to margin pressure, all but for the best brands. And I think this is an environment really that we're going into where the bigger, better capitalized scale brands are positioned to gain significant market share from their weaker competitors. And so that's really the end of the pyramid that is likely to do better.
Swetha, interesting to see that Birkenstock is saying that they're going to use some of the funds, at least, that they raise here to pay down debt. Given we're in a rising rates environment, across the sector that you cover, across these consumer goods companies, is this going to be something we see other businesses doing?
So I think that is a particular function of its ownership under private equity, because the listed public companies in the consumer space are actually very well capitalized, run with very conservative balance sheets, typically either very low gearing or net cash positive, which I think makes them a relative safe haven, even in a slowing growth environment, although the market will need some time to digest the current earnings reset in order to get comfortable with the long-term compounding appeal.
Swetha, thanks so much. Thanks for joining us. Swetha Ramachandran, fund manager at Artemis, taking us through one of the important sectoral stories that we're covering this morning. We'll certainly keep luxury stocks in focus. Let us get a broader look at the stocks that we're watching. Joe Easton from our equities team joins us with a briefing this morning. Joe, good morning. I think we're starting with chips.
Morning, Anna, absolutely. So Samsung overnight jumping around 3%, despite the company in Hong Kong reporting a 13% drop in their revenue and a fourth quarter consecutively of declines. Now, analysts say the strong part is not the devices like laptops, TVs, that kind of thing, it's the chips. And the chip prices do seem to be moderating in terms of those price declines we've seen, and therefore the company's losses have narrowed, making up for some of the weakness, as I say, in the sales as we got on the bullets here. Now, this could potentially be important for a couple of chip makers here in Europe, including ASML, Infineon and ST Micro, as we can see, had a bad 3 months following a couple of profit warnings, given concern around demand, particularly over in China, but potentially a positive read across today.
And Joe, Novo Nordisk back in focus once again for us.
So Novo Nordisk, really interesting story. Now, they have said that their Ozempic drug, which we all know as one of their weight loss products, they've been trialling it in kidney failure in terms of patients that have diabetes. And they announced last night that they've stopped this trial early because they're sure that it will succeed. Analysts at Barclays saying that this is showing that this drug goes beyond its original purpose. However, this is likely to be a negative for companies like Fresenius Medical here in Europe. They're based in Germany, and also the parent company Fresenius as well, because they do dialysis, the biggest makers of dialysis in Europe. We saw a few US companies falling following that news, so they could be weaker this morning.
And the brewing sector in focus this morning, Joe.
So the brewers have a note out from Morgan Stanley. Now, Morgan Stanley is saying that the bad weather over the summer, so the wet weather, that will hurt Heineken and Carlsberg the most due to their geographical regions. Now, these stocks, we've seen a bit of weakness recently, and MS writing that beer volumes could fall as much as 10% in the last quarter, and the sunny September won't make up for it. So they downgrade their rating on Heineken, but they actually upgrade Carlsberg, saying that the new management might be keen to seem bullish at their latest earnings reports. They go positive on that one. AB InBev remains the top pick, but we can see Carlsberg getting that upgrade, and they now have 15 buys, only 3 sales, so a bit of positivity despite the weather once again being at the focus for those drinks makers.
OK, Joe Easton from our equities team, thank you very much indeed. Joe, now there is another geopolitical story above and beyond the crisis, of course, in the Middle East. And this involves Canberra and Beijing. It involves Australia and China. And the reported release now to Melbourne of the former journalist Cheng Lei, a journalist, in fact, with CGTN, which is the state broadcaster, who was detained in 2020. And there's the importance, of course, for Cheng Lei and her family. She has 2 children who have been in Australia this whole time. But also there's the importance of the geopolitics and what it tells us about the relative warming of ties between Australia under this Labour government and China. And you've seen that at the trade basis as well, products like iron ore and coal. But now, of course, in terms of the very personal story of Cheng Lei. So, again, it tells a broader geopolitical story about some of those frictions between Australia and China, at least on the edges, starting to soften.
Absolutely, and there are plenty of geopolitical themes to deal with this morning, aren't there? Not least the violence in the Middle East. And it is in that context that we're seeing leaders gather at NATO for a meeting. We're actually seeing live pictures of this coming through now. And we understand that Volodymyr Zelensky is arriving with Jens Stoltenberg, who leads NATO, of course. And this is really interesting because, of course, Zelensky will be wanting to keep the focus of NATO on his battle, on the defence of Ukraine, where he will be acutely aware, of course, of the international community switching its focus, or at least sharing focus with Israel and the war that is taking place between Israel and Hamas. So we'll continue to bring you a focus on these geopolitical themes. We'll keep across these developments at the NATO meeting as they take place in Brussels. The market open, though, is coming up next. We will watch what's happening with the start of trade. US futures pretty flat this morning. The open is next. This is Bloomberg. Minutes to go until the start of cash equities trading. Welcome back to Markets Today. I'm Anna Edwards in London with Tom Mackenzie.
And here are your top stories. The US speeds up military assistance to Israel. Turkish President Erdogan criticises Biden for sending warships to the region. Elsewhere, Treasury yields drop by some of the biggest margins this year on hopes the Fed could be done raising interest rates. Shares in Asia rally for a 5th day. Plus, LVMH sees sales growth softening in the 3rd quarter. More evidence the post-pandemic luxury boom is waning. And certainly that will be a factor as we look at European equities when they open. The luxury sector will be in focus. The healthcare sector as well, on the back of some news coming through from Novo Nordisk. But more broadly, this is still a market that is assessing the next steps from the Fed and where rates end up.
Yeah, and the geopolitics alongside that as well. Also part, as we've said, of that fixed income conversation for certain. Let's have a look at where we are across a number of assets then, Tom, this morning. And this is where we are on that Asia-Pacific story. Tom, you mentioned in the headlines the strength we're seeing in the Asia session. We had a really strong session in Europe, though, yesterday, up by more than 2% on many of the major markets in Europe. So MSCI Asia-Pacific up by 0.9%. The Fed conversation crucial there. Bear in mind, S&P futures flat. That's indicative of what we're seeing looking ahead into the US session. The US dollar also pretty flat. Worth noting, given what we've seen of late, oil prices are flat compared to what we've seen in the immediate aftermath of the attack on Israel and Israel's response. Iron ore futures, putting that one in there to show a little bit of rebound in some of the commodities that have been under pressure of late. So iron ore up by 1.2% this morning, Tom.
OK, the futures then, and the standout really is what is shaping up for the CAC current, looking lower, pointing lower by about a full percentage point right now. FTSE 100 looking and pointing lower by about 23 points. It looks like it's going to be a tough session, certainly for France.
Absolutely. So the luxury sector springs to mind, doesn't it, when you look at that divergence between the CAC 40 and the rest of Europe. So expecting to see LVMH as one of the stocks that stands out to the downside in a moment. But in terms of the big picture, this is the Spanish IBEX then, down by 0.5%. The FTSE 100 down by 0.2%. So the sense being perhaps that we've rallied so far yesterday on that Fed theme and on some... well, mostly on that Fed theme, really. So that seems to be what markets are focused on unwinding a little bit of this morning. Here's the euro fairly flat. In fact, across FX land, we're fairly flat this morning. Interesting to note what's going on with the US Treasury yield curve, because we see buying at the 30-year and that yield coming down. We actually see the opposite at the 2-year. So we're seeing some interesting moves, divergent picture between the 30 and the 2 years, so the long end and the very much shorter end of the curve. In terms of the European sovereign bond story, we see selling there. We see those yields going higher. Of course, the story of the last couple of days has been asking whether yields had topped. Maybe today looks a little bit bit different. And a mixed picture, really, on commodities coming through. So we see some weakness after recent moves higher, driven by war in the Middle East on natural gas prices. So those both down by around 5%, the UK natural gas and the European benchmark. Brent crude up 0.4%. Tom, what do you see on the sectors?
Well, that reflects in the energy sector, currently gaining 0.4%. One of two sectors, two of the major sectors in the green at this point, of course, in the first few seconds. Basic resources now turning on to the downside. Basic resources have been one of the leading gainers yesterday. And you saw at the top of the list, travel and leisure yesterday closing out with gains of more than 4%. That is shifting today, and the focus really is on the luxury space, those consumer products, and that sector now down by 1.6%. What is shaping up as well in terms of the auto sector is further downside there, 0.6%, and travel and leisure giving up some of the gains of yesterday, but nowhere near pairing the 4% upside that came through for that sector, currently down 0.4%. That is the picture again, the focus really on the luxury space on the back of some disappointing, for the markets at least, and the analysts, disappointing sales that came through from LVMH. A little bit of softness in Europe and concerns maybe that China isn't going to come back and isn't going to be shoring up the luxury space. We continue to unpack that story for you right now across the benchmark, downside of around 0.2%, given the gains yesterday, just giving up some of that at least. The FTSE 100 currently off by 0.2%, and we're waiting for the CAC count to reflect. This is yesterday's pricing. We will get that for you, of course, and we expect to see some downside for the French major index in terms of the pressure that's coming through for luxury. Anna.
Yeah, a day where a lot of focus on that sector, it seems. The CAC not open yet, the DAX not open yet, voting for both of those. The no trade in LVMH to report to you yet either. So we are, as you said, that was yesterday's move on the CAC 40, the strength we saw in yesterday's session, waiting for some of that to unwind on the back of that LVMH story. Looking into the consumer product sector, we are seeing some of the other businesses a little similar to LVMH, so other luxury goods down by more than 4% in session today. So no doubt a theme we will certainly return to. Sam Unstead joins us from our Markets Today blog this morning and can tell us a little about some of the stories that we're dealing with here today. And it's interesting because China is one of the things that you flagged as of interest. And, you know, there's a China dimension to these luxury names in France that are waning. So we see Richemont, Moncler, Bruno Cucinelli, Burberry, Christian Dior all down by more than 4%, Kering and the rest all down by more than 3%. Waiting for LVMH to open up. What's the China focus for you this morning?
Yeah, I think so yesterday, some of the China news coming through really boosted, particularly the FTSE 100 yesterday. So, Tom, you just mentioned that basic resources are very strong yesterday. Some of that was because it's been a very volatile week so far, and so there was an element of kind of recovery there. What we're now watching for is, my colleague Sophia Hortry-Costa came on here yesterday and said this new stimulus that China is said to be considering is still not the bazooka that everyone is looking for. But we are still waiting to see what it is actually going to be. And so we're, at the moment, we're kind of waiting on China to see where the story goes next. OK, from China to the US then, and the comments from Mary Daly. She's not a voting member, but as Venram from our MLive team points out, she's known to be a hawk, and she's talking about a new neutral rate in terms of potentially getting to around 3%, and what that could signal then for markets longer term. Yeah, and this is an interesting comment. And like you say, she's not a voting member this year, but it's still a comment to take into account, especially because this week we've had a lot of debate in terms of the way that bond yields have moved, as to whether that has done some of the work of raising rates again. So the debate really seems to have ramped up. We had Neil Kashkari as well speaking yesterday, discussing that exact topic.
I just need to correct myself. She's not a known hawk, she's a known dove, and that's the importance
she is, yeah.
that Venram was pointing out in terms of her comments, that maybe the new neutral rate is around 3%, or at least between 2.5% and 3%. Just wanted to flag that, Anna.
OK, yes, absolutely. Just a quick mention of LVMH, as we've been keeping our eyes on the open of that stock. LVMH, such a mega-cap stock here in Europe, vies for that top spot, of course, with well-known diabetes maker, but drug maker. LVMH falling 6% on disappointing third-quarter sales growth. So that's the latest on that space. We'll continue to watch the fallout from that. We see other luxury names, as we've been mentioning this morning, falling on the news out of LVMH overnight. Other news in focus, I suppose this sort of water cooler story that everybody is talking about, and this is Sam Bankman-Fried and the latest that's happening there on the crypto space in the aftermath of his company's demise.
I think we've talked about this story in the past, actually, and this is sort of a story that's going on in the background of the crypto market at the moment. And you know, the moves there have not been particularly wild, but it is certainly a story that's feeding into still a little bit of nervousness. You had an interesting story about Binance and their founder, sort of the kind of money that he'd put in to try to kind of, if you like, save the crypto market has kind of fizzled out over the last couple of years. But yeah, at the moment, still feels like it's sort of going on in the background and is very much a story about Sam Bankman-Fried rather than the broader crypto market, at least at the moment.
Yeah, fascinating in terms of the court appearances and what we're hearing from that trial. Sam Unstead from our Markets Today blog, walking through some of the key themes for these markets and some of the colour around the trial of Sam Bankman-Fried. Thank you. You can get more, of course, from the team on the front page of the Bloomberg UK website or by typing TLiveGo on the terminal. Here's the big corporate story of the day, though. It is LVMH, and it's a squeeze coming through across the luxury sector and the weight that is having in terms of the downside for the CAC 40 over in France. LVMH currently down 7.7%, so a significant fall in terms of LVMH. But it's also, as Anna was saying, hitting some of the other luxury names unexpectedly, of course, or expectedly, I should say. Kering is down close to 3%. Hermes is off by 2.7%. So the big luxury names taking a hit from the softer-than-expected sales data out of LVMH, Anna.
Yeah, and as we were hearing from our guest earlier, it was across a whole host of business lines, wasn't it?
Yeah.
So it wasn't as if it all fell in one business line. And as a result of that pain we're seeing across the sector, Tom, consumer products and services, by far and away the weakest performing sector today. And the sector as a whole is down by 4.1%. So this is really taking a huge chunk out of European stocks this morning, and a sector we keep in focus. Let us take a look at some of the events that we're following for you today. We've dealt a little with some of the luxury stories. Let's move to some of the events on the geopolitical calendar, the markets diary, the IMF and World Bank annual meetings. They're continuing in Marrakesh over in Morocco. That's where Janet Yellen, the US Treasury Secretary, will hold a press conference at 9 a.m. UK time. Then at 1:30 p.m. UK time, we'll get US PPI data. Of course, that comes a day before the CPI print out of the US. That'll be closely watched. German footwear company Birkenstock makes its trading debut in the US later. And at 7 p.m. at UK time, we will get minutes from the FOMC's meeting last month. And it's interesting, the minutes conversation, often we talk about how they're backward looking and they tell us, you know, the static picture in time rather than sometimes by the time we see them, they are a little out of date. But even Anna Wong of Bloomberg Economics saying they will offer us some interesting insights into whether we are really going to get another hike from the Fed in November. We've heard a lot from some of the doves around they don't think necessarily we need one, given what's been going on in bond markets, but not so much from the hawks, and you wonder if you get some pushback.
And to your point, Anna Wong's suggesting that maybe there's an opportunity, there would have been an opportunity for those officials to push back on the dot plot, of course. They'd marked the dot plot that there was going to be another hike coming through by the end of this year. Given the commentary we've had, at least from 3 of those Fed officials, it suggests that they are rethinking that. So whether that comes through in the minutes will be important. And then, as you said, the inflation story as well, rounding that out. And I just have to question, given some of the reporting from the Bloomberg, whether or not that focus is now shifting from inflation on the assumption that it continues on its downside to those credit risks. And that's something that we were talking to Tatjana Greil-Castro about earlier in the show as well.
Yeah, absolutely. And Birkenstock, the listing of that business in focus. We've learned a little bit about the pricing. We were talking to our analyst earlier on in the programme about what's in focus there. Really interesting to see that the business is saying that they will pay down debt. But as she pointed out, of course, they have private equity ownership, and so that would be expected. And she was making a distinction between that and other businesses within this space where she didn't see such issues with debt levels, and therefore we're not necessarily going to see a wave of consumer businesses coming to equity markets to look for cash to pay off the cost of those dets as they rise.
Oh, debt. It's really about the Barbie bump, isn't it, Anna? Isn't that the more consequential story for Birkenstock? Birkenstock and the Barbie bump.
Story there.
Interesting. Bloomberg Intelligence, by the way, thinks they're pointing out they have just 1% market share at this point. So they're suggesting, look, there is huge growth potential for this business if it goes beyond the Barbie bump. Thank you. Right, in terms of the update there for Birkenstock. Coming up, Novo Nordisk is, of course, topping the Stock 600 leaderboard once again today. LVMH is playing a role in that, but also its recent drug trial success. More stocks on the move with the one and only Joe Easton. That is next. This is Bloomberg.
This is Markets Today. We are 12 minutes into our European trading session, and real divergence across European equity markets depending on how many luxury names are listed in your index. Let's get an update on some of the individual stock moves. Joe Easton has a briefing for us. Joe.
So LVMH slammed in the opening trading over in Paris. Now, this could potentially be the biggest drop since the COVID-19 outbreak almost 3 years ago. It was down around 8% a few moments ago, coming back up slightly down 6%. Now, Morgan Stanley is saying that the surprising issue in this release is that the European buyers are much weaker than expected. Chinese demand actually held up better than they thought it would, according to Hermes. So we're seeing Kering also declining, one of the biggest droppers, the owner of Gucci. And also the drinks makers are dropping as well. We've got Rémy Cointreau on the screen, also Pernod Ricard, the big makers, with LVMH reporting softer sales in the Moët and Hennessy drinks brands, alongside the clothing as well. We've also brought up Heineken. Now, they've got a downgrade over at Morgan Stanley, actually holding up pretty much better than expected, but slipping at the moment. So drinks in focus following that note, and also those LVMH comments. Then over in healthcare, it's all kicking off today. We've got news from yesterday from Novo Nordisk that one of their weight loss drugs can potentially stop deaths in liver and kidney failure, and that one is boosting that one around 4%. Dialysis makers Fresenius down 20% at the moment in Germany. That is potentially the biggest drop on record. They went public in 1996 and haven't fallen as much as that in their history. GlaxoSmithKline, huge news for them. They've settled a Zantac lawsuit over in the US. This is their drug for throat illnesses that potentially caused some cancerous illnesses, and they say they've settled. They haven't disclosed how much they're paying, but that stock is rising at 1.5%. Couple of other big movers, lots of big moves today, particularly here in the UK. Noting quickly, Travis Perkins, they are saying DIY sales slowed down in September. Page Group, the recruiter, seeing a decline in some of their fee income. That's the recruitment firm. And also AP Moller-Maersk downgraded at Deutsche Bank, who said shipping demand is starting to slow, and that one is down 2%.
Joe Easton from our Equities team, thank you very much indeed. Right, let's get some more analysis and calls on these FX markets. Treasury yields posting some of their biggest single-day declines all year. Yesterday, it's pretty pronounced. On expectations, the Fed could be done raising interest rates. That followed comments from several Fed speakers. The dollar consolidated as traders await producer and consumer price data, as well as Fed minutes. The minutes out later today for clues on the rate path ahead. Athanasios Vamvakidis, then head of global G10 FX strategy at Bank of America, joins us for the take on the FX market. So there we have it, Thanos. We're getting clear signals from Fed officials that we are getting to pause territory, that enough work is being done by these bond markets in terms of tightening of financial conditions. The Fed doesn't need to do more. Sell the dollar, Thanos.
Well, I think the message from the Fed is that they're done, but we still don't know if their job is done. I wouldn't call it wishful thinking. I would call it hopeful thinking. Inflation is moving in the right direction, but has been sticky, and the US economy has been very resilient. Most likely, for now, the risks to the dollar are more balanced, particularly given the strong rally we have seen since the end of July. But really, where we go from here depends on the landing scenario that we're going to see. And for the dollar to really weaken, because it remains historically very strong, we need the Fed to shift its focus from inflation to growth. And I don't think we are there yet. In the short term, we don't necessarily believe that the dollar can strengthen too much from where we're here, but a lot depends on the data. And once we get the so-called landing scenario, a lot depends on whether this is what it takes for inflation to start coming down, so eventually in the medium term to long term, the dollar starts to weaken, or we get a stagflation kind of scenario or slowflation scenario in which the dollar can get even stronger. So there is a lot of uncertainty on where we go from here.
A lot of uncertainty about where we go from here, and that's just on the dollar side. Plenty of other currencies to talk about, of course, as well. Thanos, I was reading some analysis by another house talking about how the pound is at risk from deteriorating data. I mean, maybe you apply that to the dollar as well, but it has a different reaction function. But if the pound is vulnerable with deteriorating data, the IMF talking about how rates need to stay, well above 5% and stay there for a year. The Bank of England talking about how they need to stay there, Table Mountain style, for quite some time. What do you expect to see on the pound?
Now, the pound so far had a good year, to a large extent because the market was too pessimistic on the UK economy. Data has been weak, but better than expected. Recently, we have seen some negative data surprises. Also, the fact that the Bank of England effectively has affected sterling. Now, on cable, it's all about the dollar. On euro sterling, it's very difficult to get too bearish on sterling because the data in the Eurozone is also very weak. So I would argue the risks are balanced, and both the Bank of England and the ECB, effectively, they are done. So it's all data dependent. It is hard to have a strong view one way or another on sterling, I think.
OK, but to be clear, you do think the BOE is probably done at this point?
I think everybody's done. This is what the Fed, the ECB, the Bank of England, they are done hiking. I don't think they're done fighting inflation. And in a positive scenario, inflation is sticky, but at least it continues moving in the right direction. In a more negative scenario for risk, which will affect the dollar positively, we get stuck somewhere on the way.
Is weaker pound still a risk for inflation, given how much energy we have to import into this country?
Up to an extent, yes, but I don't think this is a driver. I think the key in the UK in particular, but also in other economies, is the labour market, because regardless of everything else, it is extremely stretched everywhere. And wages are increasing more than the core inflation rate in most cases. So we already have second-round effects. We need to see a weaker labour market to feel confident that inflation is really on its way down.
Can I ask you what's going on with the yen? Because you have some very eye-catching calls about the yen, Thanos. We've seen, of course, something happened when the yen got to about 150. Well, we'll have to leave it to everyone's analysis to work out what that was. But you've got a suggestion that you think it peaks at 155, but under certain criteria, it could go to 160, 165. What would take us there?
Now, we do assume that the Bank of Japan will stop yield curve control and will move rates back to zero in Q1 next year. Until this happens, we still believe the risk for dollar-yen are to the upside. But then what happens next depends more on the Fed, because we don't expect a proper policy normalization by the Bank of Japan. But if the Fed does not cut rates next year, which is a likely scenario, then we see dollar-yen moving to 160 or even 165 because of the carry.
Thanos, thank you very much. Thanks for joining us. Athanasios Vamvakidis, Head of Global G10 FX Strategy at Bank of America Global Research. That's the FX conversation. This is Bloomberg.
Welcome back. This is Markets Today, 23 minutes into the European trading day. European stocks pairing some of the earlier losses of the session, but the luxury space is weighing on consumer as a sector, currently down a little over 3%, given disappointing sales numbers out of LVMH. Energy is at the top of your list, gaining 0.9%. And on energy, we have a redhead that crossed the terminal just in the last minute or so. Qatar Energy signing a 27-year LNG supply deal with France. So a long-term supply deal with France, of course, as Europe continues to readjust to the need for LNG, liquefied natural gas, from suppliers other than Russia, in the light, of course, of Russia's invasion of Ukraine. Qatar Energy, by the way, has previously signed deals with Germany, with the Netherlands and with China as well. But this is France signing a 27-year LNG supply deal with Qatar Energy in it.
And worth noting, given we're heading into cooler weather, we understand from Maxar Technologies that temperatures will drop over the weekend. Cities, including London and Paris, could be 5 to 6 degrees cooler than normal. There's not been cool at all recently by Monday. So this is worth considering when we're thinking about gas markets at this point.
And European gas is easing this morning after rising about 30% this week. This is the broader story, but with the focus on what's happening in Finland, because it comes as Finland treats a gas pipeline leak as suspected sabotage. And a line just crossing in the last minute or so, Finland identifying small seismic event when that pipeline was damaged. Let's get the latest then with our reporter on the ground in terms of what may have been the cause. Ott Umelas, who's Bloomberg's editor for Nordic economy and government news in Oslo. Ott, thanks for joining us. How likely is it ultimately that Russia was behind this?
Now, this is the theory that the pundits have obviously brought up ever since the leak was discovered. And what we do know at this point is officials in both affected countries, so both Finland and Estonia, have been careful to avoid mentioning Russia and have basically declined to comment on whether Russia could have been behind this. but they basically say it's likely caused by external actors or external actions. And why they're saying that, there's besides the gas pipeline leak, there's also the telecoms cable close to Estonian coast that has been damaged basically in the same time window. And since these events geographically they're a bit apart from each other, basically that's also one part of the reason why authorities suspect this is deliberate.
Oh, very briefly, what do we watch next? There's a NATO meeting coming up.
Yes. We do know that the technical investigation is going on. Basically, since the incident was in the not directly in the Finnish territorial waters, this implies that it sort of couldn't bring in any scope of NATO response.
Okay.
But
I do apologise. I'm going to have to jump in because we're about to go to a break. But thank you very much for bringing us the update. Bloomberg's Artemis. This is Bloomberg. This is Markets Today, 46 minutes into your European trading day this Wednesday, and European equity markets actually mostly in the green, apart from the CAC 40, which is down by 0.5% this hour. Let's go to the source of that negativity. Shares in LVMH are under pressure today following disappointing third-quarter sales growth. The drop saw the French luxury goods giant briefly erase all its year-to-date gains. Let's get to Bloomberg's Caroline Cornan, who joins us now from Paris with details. Caroline, is LVMH resisting the slowdown in China? Certainly something negative in these numbers.
Clearly not resisting the slowdown in China, at least from the investor reaction in the share price this morning. LVMH, quite a different story from the beginning of the year when luxury was seen as the new tech driving the CAC 40. Today, as you just mentioned, erasing their year-to-date gains. They suffer from weak demand in China, soft demand in the US, and also soft demand from their champagne division, and also still inflation impacting the aspirational consumer. If you look at the detail, the biggest division, which is the leather goods division, is up 9%. That is missing estimates. That's, of course, Louis Vuitton, Christian Dior. The wines and spirits division, minus 14%, much worse than expected. That division suffers, for example, from soft demand for cognac in the US, soft demand also for the jewelry and watches division, even though Bulgari is doing slightly better than Tiffany, which is more exposed to the US consumer. There was only one bright spot, which is the retail division and strong strengths at Sephora. But the CFO, Guillaume, said last night that we're seeing some kind of normalization at LVMH after years of growth. But it is the first time they miss in more than 3 years.
Yeah, first miss in more than 3 years. Important context. Is that it then, Caroline, in terms of the luxury rally? Is the luxury rally over now?
Well, it's hard to imagine that the luxury stocks will stay out of fashion forever, but really depends on when China reaches the bottom. In fact, if you look at LVMH in the third quarter, the sales in Asia, excluding Japan, were still up 11% the last quarter. Morgan Stanley is saying that Chinese demand will still represent about 12% of luxury spending next year. Of course, it will also depend on the US situation, whether we're seeing a recession and whether we're going to see also some rebound in, especially in the wines and spirits division over there. However, some other things might help. For example, higher oil prices, which could boost spending in the Middle East going forward.
OK, Caroline Corner in Paris. Shifting focus now, and a story that is evolving. Australian journalist Chung Lei has flown back to Melbourne after being released from detention in China. Chung was first detained by officials in Beijing in 2020 on espionage charges. Let's get more then on this story with Bloomberg's Emma O'Brien, who is in Sydney. Emma, what does this say about relations then between China and Australia? and how those relations have shifted.
Yeah, I mean, I think it's obviously a sign of a real improvement and a restoration of relations between China and Australia. Cheng Lei was detained at around the lowest point in those ties, which came after the former Prime Minister, Scott Morrison, called for an inquiry into the origins of COVID-19 and made some aspersions as to China's role in that. She was detained on espionage charges around that time, and since then Australia has seen a lot of retribution from China. But since the new government has come into power following the Morrison one, there has been a slow rapprochement and a restoration of ties, of which this is a very firm signal that those are on a better footing.
Emma, thank you very much. Bloomberg Senior Executive Editor Emma O'Brien in Sydney with a briefing. This is Bloomberg.
This is Markets Today. We are 53 minutes into European trading day. Sentiment has turned positive. European equities are now posting very modest gains. US futures are pointing higher, and a lot of that is down to what's happening in the Treasury market, with yields coming quite sharply, falling quite sharply in terms of yields. Let's get more then in terms of the analysis around particularly the Treasury markets, and bringing Eddie van der Walt joining us from our M Live team. So, Eddie, quite sharp moves lower in terms of yields. Most specifically, or most prominently, I should say, towards the back end, the 10-year yields moving lower by 8 basis points, 457.
Yeah, definitely a bit of a move into havens, right? You've got to wonder whether this is about geopolitics, which, you know, we're constantly seeing that in the background at the moment. At the same time, there's somewhat of a you know, circularity to the Fed's argument, saying that, you know, if we see you know, longer dated yields high, then we don't have to hike so much. But if we don't hike that much, maybe we don't see, you know, yields at the back end that high. So there's you know, I think some markets are testing the circularity in the Fed, but at the same time, there is definitely, you know, we've seen over the last couple of days the yen, gold, and of course treasuries wanting to get a bit of a bid.
Yes, and on that geopolitical tension that maybe is pushing investors into treasuries, into the perceived haven that they might think they find there. Israel, a headline crossing the Bloomberg, Israel saying that an anti-tank missile was fired from Lebanon at a military post. We've seen some levels of violence across that border, but we continue to watch that to see if we get meaningful escalation. That is, of course, a fear in the region. So that's the geopolitics, and that maybe is playing in here as well. Oh, in terms of the data and the calendar we have ahead of us then, Eddie, we've got PPI today and CPI tomorrow. Still a focus on inflation, I'm sure.
Yeah, look, it's unusual. PPI comes first this month, and I think, therefore, PPI is the big one, right? Usually we really trade on CPI and kind of dismiss PPI, both because it is, you know, it's not focused on the consumer, but also because it comes second. Now, this time, there is, if you look at the data, there is a strong correlation. You can predict CPI if you get the PPI number first. And because we do today, I think some of that volatility shifts forward. Traders will trade PPI as if it is CPI. And therefore, I think there's going to be a lot of action around that. And, you know, Markets Live will obviously go very big on the coverage for that.
What about Fed minutes? How much focus will there be? So Anna Wong and Anna here was pointing this out from Bloomberg Economics, pointing out that arguably the Fed minutes are more important this month.
You know what? The Fed minutes are important. We want to kind of see whether, you know, the comments from Daly and Jefferson and Logan is backed up by the rest of the crew at the Fed. You know, whether the rest of the council says, yes, you know, long end yields will help us tighten monetary conditions and therefore we don't have to hike so much. But at the same time, you've got to wonder whether those minutes are not now a little bit out of date, because we have had a lot of dovish commentary come through.
Right, yeah. Were they thinking those dovish thoughts at the time of the minutes, and now would that stand up against the dots, I suppose? Eddie, thank you very much. Thanks for joining us. Eddie van der Walt from our Markets Live team with a reminder of the top stories that markets are focused on this morning. And remember, you can get up-to-date analysis from Eddie and the rest of the Markets Live team. MLIV Go is the function to use on the Bloomberg terminal. Plenty more still to come. This is Bloomberg.